The 31st of March is a date many Australian businesses miss. The 2026 FBT deadline is now on the approach. But the real danger isn't a fine. Failing to lodge an FBT return can give the ATO an unlimited time frame to audit you. And the ATO is watching. They use data analytics, cross-referencing payroll to vehicle registrations to find you. Why? They're chasing a $1 billion FBT gap, and they're targeting small and medium businesses to close it. In this guide, we'll show you the common traps and give you a clear checklist for March 31st compliance. First, the basics. The FBT year ends on March 31st, not June 30th. This single detail is a huge source of error. The FBT rate is a steep 47%. It's set to match the highest income tax bracket, making any mistake costly. To find the tax owed, the benefits value is grossed up, calculating the pre-tax salary needed to purchase it. This affects your staff. If benefits top $2,000, you must report an RFBA on their income statement. So, we have a high tax rate in a fast-approaching deadline. But why has the ATO become so aggressive on FBT? Recall that $1 billion FBT gap? That is the ATO's public target. They see it as easy revenue from SMEs. Their main weapon is data matching. They automatically compare data from multiple sources to find contradictions. For example, their system sees a vehicle registered to you, garaged at an employee's home, but no FBT reported. Flagged. Another red flag is entertainment spending. The ATO sees businesses claim 100% tax deductions, but report zero fringe benefits. So the ATO is motivated and equipped. What are the costliest mistakes they find? It starts with one thing: vehicles. The number one FBT trap is private use of work vehicles. If an employee's work car is at their home, it's available for private use. To prove business use, you need an ATO-compliant logbook, but an incomplete or invalid one is worse than having none at all. If the ATO rejects your logbook, they default to the statutory formula, assuming 20% private use, often creating a massive tax bill. But what about dual cab utes? Aren't they automatically exempt from all this? This is a dangerous misconception. The exemption only applies if private use is minor and infrequent. Daily school runs void it. The rules for vehicles are also shifting. From April 1st, 2025, plug-in hybrids generally lose their FBT exemption. Remote work brings new FBT problems, from home office gear to cars for employees working in different states. Even a car park spot can trigger FBT if the daily commercial rate nearby is over the threshold, just $11 free for 2026. The rules are complicated and shifting. So how do you protect your business? By connecting the risk to a proactive plan. Let's put the pieces together. Recall the unlimited audit period from the start and the invalid logbook we just covered? Here's how it happens. A data match flags your car, an audit finds your logbook is invalid, and a tax bill is calculated. If you never lodge a return, that audit can now stretch back indefinitely. This is why you must check records before March 31st. A powerful way to reduce FBT is with employee contributions. An employee paying towards a benefits cost reduces its taxable value. For small perks, use the minor benefits rule. A benefit under $300, provided rarely, can be totally exempt. To manage this, use technology. Automated expense platforms can flag FBT liable spending and simplify year-end reports. So what goes on your action list before March 31st, 2026? 1. Check all vehicle logbooks for correctness and collect odometer readings on March 31st. 2. Review meal entertainment, travel, and parking costs. Get all required employee declarations signed now. 3. Work out any employee contributions and prepare to report reportable fringe benefits amounts for your staff. FBT isn't just tax, it's risk management. Acting before March 31st moves you from a position of risk to one of control.